Good morning and welcome to the portfolio update on the TB Amati UK listed smaller companies fund. I'm Colin Thompson, one of the salespeople at Amati, and updating you today I'm joined by Paul Jordan, Anna MacDonald, David Stevenson and Scott McKenzie from the UK Smaller Companies team. In the UK market, it's been a challenging year for UK SMID with small cap, mid cap and AIM, all these indices experiencing significant setbacks, while an overweight in large cap would have served you well. With that in mind, the first part of the presentation, we'll attempt to give some context around this by looking at the reasons behind that outcome, the differences in composition of the indices, and reviewing what happened following the previous bear market drawdowns. If you're reviewing your UK equity exposure, is there an opportunity in quality UK smaller companies with valuations significantly lower than recent history? We'll then focus on our own portfolio, looking at the characteristics and metrics, what we've been buying, how it's positioned to benefit from that dislocation between valuations and growth potential. We're cognizant today we're the warm-up act for the Chancellor, so the formal presentation will finish at 11:30. We'll then answer any questions that you put through the webinar page. With that, I'll hand over to Scott.
Thank you, Colin. Good morning, everyone. Thanks for joining us today. As Colin alluded to, it's been a very difficult time for UK small mid-cap investors, and the past 12 months really have been extremely testing, to say the least. And we can see from the chart on page 3 how that's come out in terms of performance. As Colin mentioned, actually large cap has held up remarkably well in the UK over the past 12 months, but the same cannot be said for mid, small and AIM. And obviously the core of our fund is based on small cap and AIM in particular. So it's really been one of those years to forget for small caps. We do get this from time to time, and it's been a particularly difficult and challenging year for investors in UK SMID. And this is kind of demonstrated in the chart on page 4, which looks at the IMA unit trust performance for various asset classes. It's a more global view of the world, if you like, looking at all sorts of asset classes as measured by the IMA at the end of September. And on the chart, we've highlighted the main UK equity classes within the table, and unfortunately we can see that UK smaller companies has been the worst performing IMA sector over the past 12 months. So it really has been a very tricky period indeed. That's not unique to the UK. We can see at the bottom of the chart we also have the European smaller companies sector, which has been almost as weak as the UK one, and we're joined at the bottom by UK gilts and China. So really a tough year for small caps in general. And if you look at the far left-hand side of the chart in red, we can see that the best place to be has been in large cap value, and that's demonstrated really by the UK equity income sector holding up relatively well in an otherwise poor year for UK assets and for global assets in general. So it's been a tricky 12 months overall. When we drill down into the differences between smaller and large cap companies, what we've done in this chart is look back over 20 years or so. And the red bars are the annualized performances for our own benchmark, which we use in the Amati fund, which is the Numis Small Companies plus AIM benchmark. That's shown in red, and these are annual returns over that time period. And we can see that we do have these years where we have very significant drawdowns, the current year being one of them. And if we look back, we had a similar period in the early 2000s and in the global financial crisis of 2008. What's interesting is, though, that these tend to be characterized by being relatively short and sharp, those downturns. And indeed, post the last global financial crisis, we can see a very, very significant fall in 2008, followed by an equally dramatic recovery in 2009. So generally speaking, these very severe drawdowns tend to be relatively short-lived, certainly in recent history. The exception perhaps being, in 2000, where we had, got a couple of very difficult years, but again, followed by 4 or 5 years of pretty strong recovery. So the small cap does tend to have a high beta in a bear market compared to the large cap, and that's indeed what was seen in the current year. And if you analyse the differences between small and large cap, really it comes down to the sector mix. There are some fairly material differences between our Numis Small Cap plus AIM index, as shown in the red bars, and the Numis Large Cap index, shown in the grey bars. The Numis large cap is pretty similar to the FTSE 100, really. So it's a pretty good overall benchmark for larger UK companies. And we can see when we drill down into the sectors how dramatic the differences can be. And in the current year, we can see that the information technology tech sector is quite material in the context of the small cap world. So over 12% of our Numis benchmark is in the tech sector, compared to a very small amount for large UK companies. So we have very few large tech companies in the UK, and that's one of the reasons why larger companies have performed relatively well in the current year. Another notable sector to highlight would be energy, and we can see that the large cap index is almost 14% in energy, dominated by BP and Shell. Have had particularly strong recoveries, in particular post the invasion of Ukraine earlier in the year. Final sector to perhaps point out in this chart is consumer staples. Again, a very material part of the large cap index at 18%, but really quite a small part of our small cap world at only 4%. So if you aggregate those three sectors together, information technology, energy and consumer staples, those are a fairly material part of the difference between the returns from large cap and small cap strategies this year. So we are very much comparing quite different indices, and we can see from that why the smaller cap part of the world would have fared so much worse in the current year. So that's some of the recent history. It's clearly been a pretty tricky period, but we do believe there are a number of things we should be looking at as potential catalysts for this trend to reverse as we move into 2023. And the first catalyst we would bring to your attention is the importance of interest rates. And that's attracted a lot of attention, particularly in the light of the Quarten Trust kind of disastrous mini budget recently, where people got very worried about UK interest rates, and quite rightly so. On the left-hand side, we've done some analysis of using some data from Investec that they produced recently, which basically tracked the FTSE 250 index, a mid-cap index, and tracked it with interest rate expectations. And there's a very strong inverse correlation between UK interest rate expectations and the performance of that mid-cap index. We don't have the full data for the small cap, unfortunately, but we can assume a relatively similar relationship for small cap as well. And what the chart is telling you is that when interest rate expectations are rising, the FTSE 250 performs very poorly indeed. And there's been a very strong correlation, particularly in the past 12 months with regard to these two things. And hopefully we can now see that beginning to come off the boil. And on the right-hand side, we look at the expectations for the Bank of England base rate. The grey part of the line looks at where we were post that mini budget on the 26th of September, and you can see that there was a very sharp downward deterioration in interest rate expectations post the Quarten budget, and indeed at that point we got to the expectations being at 6% for base rates. If you go fast forward, a mere 6 weeks or so to where we are today, and the blue line is basically showing where that kind of consensus expectation on Bloomberg is now, and it's currently sitting at roughly 4.5%. However, we do believe if anything, that could be too bearish as well. We're currently sitting at 3%, and whilst we expect another interest rate increase in the very short term, there is a school of thought which now suggests that we're getting very close to that peak in interest rates already. And we've included on the chart on the right-hand side some expectations from Berenberg, who are one of the leading UK kind of economic forecasting houses that we spend time listening to at Amati. And our recent presentation from them suggests that interest rates could in fact peak at 3.5%. So I think in conclusion, interest rates, it feels as though the worst could possibly be over, and we could get a situation where it's perhaps only 3.5%, 4% base rates. And that has implications for mid and small cap investing going forward, and may lead to a more benign outcome for investors in SMID going forward. The second thing we'd like to highlight as a potential catalyst is the strength of the dollar. And on the right-hand side, we've tracked the performance of major currencies against the US dollar since 2015. And we can see that the pound is shown in green here. It's clearly fared the worst of the three major currencies, but a lot of that came in 2016 post the initial Brexit vote. in the last year or so, really the yen, the euro, and the pound have all fallen, pretty much simultaneously. So the story most recently has been very much one of dollar strength. It's very easy to sit in the UK and think it's a sterling weakness story, but it's very much a dollar strength story as far as we can see. And the dollar has reached multi-year highs until very recently. We think there's now good reason to believe that could perhaps stabilise, and we're beginning to see the pound already respond, post the Quarantine Trush short-lived era, and we're now seeing a bit of a bounce in the pound and indeed the euro as well. So there's a case for suggesting that dollar strength may begin to unwind as we move into 2023. And the chart on the left-hand side tracks some of the performance of UK stocks which have got domestic earnings and those of which have international earnings. This is some work done by Liberum recently, which we found to be particularly insightful. And again, it says a similar thing that in 2016, from then onwards, domestic UK earnings companies started to perform quite poorly compared to international earners. And that kind of corresponds quite neatly with the outperformance of large cap that was seen more recently. Those tend to be much more international earning indices than, say, the mid and small cap. So if we see a turn in sterling and the dollar begins to weaken, again, that should strengthen the case for coming back to UK mid and small cap assets. The third thing we think is worthy of note is that the small cap index itself has basically suffered quite badly in this drawdown, and you can see that shown on the chart here, where we compare the PE ratio on the large cap index to the mid cap and the small cap. And you can see the small cap really has suffered the most in the last 12 months in particular. And we now have a PE ratio of less than 10 times going forward for the UK small cap index. So it's a fairly significant discount to the large and mid cap indices. And whilst we can't deny that there will be significant earnings risks ahead, we do believe that we're going to be compensated in the valuation for a number of those risks. So things would have to get materially worse for that discount to remain. We believe and over time we would expect that the discount in small cap to narrow somewhat against large and mid cap. So very much another reason why we think smaller companies could begin to do better from here. The fourth thing which has dominated some of the more recent discussions on UK equity market are the sheer volume of outflows from UK equity strategies. This is not a new thing, as the chart shows on page 10. We've been seeing outflows pretty much since the Brexit vote was announced in 2016. International investors have left the UK market in droves, and not only that, domestic investors have also reallocated their assets in a fairly substantial way, and that ranges from wealth managers to pension funds. There's been a very, very significant trend away from UK equities and into other asset classes and non-UK equities. And really that's come to the boil, particularly in the current year. And the political uncertainty that we've had recently has definitely contributed to some of those outflows. So really, 2022, we've seen very significant outflows from UK equities. We have no idea when or if this will subside, but certainly looking at the chart here, we've seen quite a lot of pain in the current year, and if it does indeed subside, there's a scope for a fairly dramatic recovery in certain UK equity strategies, and again, we think that would potentially favour mid and small cap funds. The final catalyst I'd just like to highlight, and I think both David and Anna will probably look at this in more detail as well later on in the chat. Basically, UK companies are now quite attractive to bidders, to private equity, to other companies acquiring assets in the UK. And we can see from the chart on the far left that the MSCI UK index is a broadly based index. It includes large, mid and small. That index has again materially underperformed really since the Brexit vote in 2016. So the world index has really done far better than the UK. And we've already covered some of the reasons for that. Some of it is currency, and others would be just the liquidity aspect and the redemptions that we've seen from UK strategies, all of which have favoured a more global asset allocation. So UK, it's difficult to argue the UK looks anything other than cheap on a global comparison, and the chart really demonstrates that it remains a pretty depressed place to be. Probably more interestingly for us in terms of our UK mid and small cap kind of focus is some recent work done by Numis, where they surveyed over 200 private equity funds and asked them where they were looking for their ideas. And the overwhelming majority suggested that they would be looking at UK listed companies as a place where there's very significant value and really attractive potential opportunities for takeovers. So 73% of the people that they surveyed at Numis suggested UK listed companies would be their main focus. So that really tells us that we should expect some more takeover activity in the UK. We've already had a reasonable amount in the current year, but that has probably seen a hiatus in recent months, and we would expect that to pick up now that we have a slightly more stable political background. So really, UK assets remain highly attractive to overseas and to corporate buyers. So there's just some ideas in terms of catalysts as to how we see a better outlook for UK mid and small. I'll now pass over to David, who'll go through some of the metrics and the fund specifically.
As you'll see from our performance, we've not been immune to what's been going on in the small cap environment over the last couple of years. Touching on what Scott was speaking about at the very end, we have seen bid activity within the portfolio reflecting the cheapness of UK assets. We've had a significant number of takeouts, which Anna will touch on in a moment. But that's not been enough to offset the fairly savage derating that's been going on in premium growth stocks, and that is and remains, has been and remains the focus of our portfolio exposure. So we've fairly fully participated in that overall small cap sell-off and underperformance. That has impacted the total size of the fund from a peak of north of $1 billion in assets. We're now down to just above 600 million. Our number of holdings is pretty much within the broad range, 65, 75 that we've spoken about before. So that decline in overall assets is disappointing, but in some ways it provides us with good flexibility to invest right across the small cap universe from AIM right up to the top of the mid cap. Our weighted averages, median average market cap has drifted down in line with that overall market performance. Has that impacted the portfolio valuation overall? This slide looks at a number of metrics. We have 3 columns here. The first column is the current forward multiples, if you like, in KPIs in the fund at 31st October. We have a comparative for that in the third column, which is just about a year ago. And in the middle, we have the closest we can get to a benchmark measure of the overall universe that we're investing in. We take this data from Quest, a data provider, which looks at their definition of UK SMID, which is not precisely our benchmark of the Numis smaller companies plus AIM, but it's a useful comparative to have. What this shows is clearly that all the valuation ratios, PE, EV sales, price to book, EV EBITDA, for the portfolio overall have moved down quite dramatically over the last year. The key things to point out are that we now have a PE ratio and indeed a dividend yield which is now in line with the overall SMID universe, which for a focused growth fund we feel is quite indicative of the derating that has happened. We're not specifically investors for dividend yield. Our approach would be that we invest in companies that we think can grow earnings and in due course will generate growing dividends. But it's quite significant that our dividend yield now is in line with benchmark. The KPIs that we look for, the quality that we're looking for within the investments that we make revolve around high free cash generation. a high proportion of profits converted into cash. That funds capex, it funds ongoing growth, it part funds acquisitions, it leaves companies in charge of their own destiny. That's also reflected in balance sheet strength. So we have a free cash flow yield for the portfolio which is above benchmark, and has actually grown over the last year, and that leaves us with, on average, overall, a portfolio where our investments are net cash relative to a benchmark where there is leverage overall. So we're invested, we feel, in companies that have a degree of optionality in dealing with the current difficult environment of rising interest rates. Another significant KPI is EBIT margin. Our focus really in terms of finding companies that have pricing power and an ability to pass through significant input cost inflation that we've seen over the last couple of years, that has to be reflected in fat margins. And you can see here, relative to our SMID benchmark, we are invested in companies that generate significantly high profit margins. So given that decline in forward multiples, which you would expect would have created opportunities for us, what have we been doing to add to our quality holdings? I'll pass over to Anna to take it from here.
Thank you, David, and good morning. Quest uses a quality score to highlight the kind of stocks that David was talking about that have the attributes of consistent and growing free cash flow generation and strong balance sheets. Here are some highlights of stocks that we've been adding to. OSB, used to be known as One Savings Bank, screens exceptionally well on quality and value. The sell-off that it experienced after the mini budget from Kwarteng was based a lot on fears that house prices would fall sharply and OSB and the other lenders would be hit. But their lending is done at a pretty conservative loan to value. The loans are about 60% loan to value, and it's secured lending, obviously. OSB has always been very cautious with respect to its impairments and the provisions it's taken. The dividend yield is 7%. And given how much excess capital they're generating, we expect that they probably will restart their share buyback. Future has been hit as if it had delivered profit warnings or downgrades, given that it is exposed to the UK and US consumer through the magazines it has online, and online presence and advertising exposure it has. That's now looking remarkably good value on 10 times PE. And a free cash flow yield of over 10%. Ashted Technology is a fairly new holding. It's a rental business. It provides rental equipment. It rents equipment for offshore oil and gas and offshore wind. 85% of the equipment can be used for either wind or oil and gas. And we know, I think we're all aware, that domestically produced energy is vital. So we see this stock being able to go from strength to strength, no matter what the economic climate is. And Mortgage Advice Bureau, again, all that news around mortgage rates and availability highlights the importance of having a good broker. These guys are gaining market share. And whilst some new mortgages written might be under pressure, given the housing market and potential weakness there, they can do some remortgage as well to support them. And we think that the stock is derated too far and have been adding to our position here. This means that our top 10 looks like this. Our largest holdings are OSB, which I've already covered. Then we've got Craneware. That services the vast and very complex US healthcare system. US healthcare spends $2 trillion over that annually. About 40% of that is sucked into administrative costs. And Craneware software identifies inefficiencies in hospital budgets and really provides a good return on investment for those hospitals that have installed it. And given their recent acquisition last year, they're now reaching around 40% of hospital groups, and they think they can sell and upsell services to them. They have a high level of recurring revenues and very strong renewal rates. So it's a stock that looks really interesting to us, and we actually hold it and know it very well from having it's been a very long-standing VCT holding. I might also point out, aware as I am of time, that Kinetic, I mean, we don't really know what Hunt's about to say exactly on defence spending, but there is a longer-term target for it to hit 3% of GDP by the end of the decade, and this might be back-end loaded, but whatever happens, we think that Kinetic is a key supplier to the UK defence industry, and also is growing a substantial presence in the US. And then the next stock 6 to 10 in terms of size, perhaps highlight Accesso. They help various leisure providers, whether it's a theme park or a ski resort, improve their customer service by using better software solutions. It allows the operators themselves to operate more efficiently and with fewer staff, which has been a key issue, the availability of staff to work in places like that. So we think that's very well positioned. It does also have quite a lot of exposure to the US, which is an economy that we're probably more confident than we are confident about than we are on the UK at the moment. And with that, I'll pass to Paul. Oh, sorry, I won't. I'll talk about bid activity just to highlight, as David said, the level of bid activity that we've seen this year. 5 companies have been bought either by corporate or private equity buyers. And once the private equity market, once we have some more clarity, I think, on the path of future interest rates, we might see some of those private equity players start getting interested again. So I'll pass with that over to Paul. Oops.
Great. Thank you, Anna. So just a very in conclusion, it might be worth just stepping back and just reminding our listeners, that those of you who know as well will know this, that what we aim to do with this fund is provide sensible exposure to the bottom 10% of the UK stock market for general UK savers and long-term savers. And we continue to think this is a fantastic asset class. It's obviously had a poor year, and there've been a lot of big macro headwinds. What I would say, and I'll try and take in one of the questions we've had here, which was about how much cash have we run during the year, given the poor conditions in the market. We've run our cash levels slightly higher than we would normally do. So we've been running between 5 and 10%. It's our policy not really to go over 10%. And what we do when we see big problems appearing in one of our regions is we try and allocate capital elsewhere. And it's almost always possible in the UK market to find companies that are well placed for whatever's coming along. So we look out for those as much as we can. And we try to, in this fund, create as balanced a portfolio as we can do. So we don't tend to, even though we have views and worries about what might happen, we obviously have to be a bit modest about how accurate our predictions of the future can be. So we don't take very extreme positions to back a particular view of the future, but we try and understand what's happening as much as we can, and then we take balanced risks, so we don't put all of our bets on one horse, as it were. So we have plenty of exposure outside of the UK. We've most of the year been running with about 55% of the revenues in our portfolio companies coming from elsewhere around the world, and that would be typical for what we do. We try and invest with a very global outlook. We are bottom-up investors. We're looking for companies that can grow through the cycle. This is a very important thing to say, and what David was touching on about high margins, we think is going to be really important for what's coming up. What we're not saying here is that next year is going to be a sudden recovery. Next year is going to be difficult. Hopefully, from what Anna's been saying, you have the gist that we're looking for, and we think we found some really resilient companies that can survive difficult times and also flourish through them. We've got a lot of different themes going on in the portfolio, many of which are really chosen because they're not going to be impacted by recessions and economic sensitivity. And one of the more difficult conversations we have is, to what degree do we go for interest rate sensitive, economic sensitive stocks? And this will be one of the things that we're really looking in terms of our weightings. At what point do we start to get confident enough to really increase that exposure? And we have increased it a little bit in the last month or so as a result of the extreme sell-off. And some of these catalysts that Scott was talking about are really things that we keep a very close eye on for, when times will get a bit more plain sailing for the more cyclical end of the portfolio, which has obviously been difficult this year. Growth stocks have, which is, if you like, our bread and butter, high quality growth companies, which were very highly rated in a ultra low interest rate environment. There's been a significant derating effect. When we're looking at our companies, bottom up, we get pretty excited about them. We think there's a lot of opportunity for them, and we're hopeful about next year without wanting to be in any way sort of downplaying the many of the difficulties which we're facing, not just in the UK, but in more of a global context. And like all of you, I'm sure we're looking forward to hearing how the Chancellor is going to tackle some of the UK's fiscal issues. And we're hoping that we're going to get a much more stable and sensible approach to UK finances, which already this has made a massive difference over the last few weeks to stabilising the gilt market. And with that, I will we'll finish the formal presentation. We're going to be staying on for any questions that you have, and please do send them through. And I'm going to hand over to Colin to chair a question session.
Great stuff. Thank you very much, Paul. First question, do you think that M&A is actually a good thing, or are US trade buyers and PE getting some fantastic companies far too cheaply? Who would like to take that one?
I'll pick up on that, Colin. That's absolutely right, the questioner. It's a double-edged sword. What we've noticed in terms of the bid activity is that whereas previously private equity might have looked for bargain basement businesses and assets and got involved in some fairly mature, if not sort of commoditized hospitality businesses, pubs, restaurants, retail, that sort of thing, they've upped their game really with the amount of dry powder capital that they have available, and they are now targeting in that sell-off environment. They are now targeting premium growth companies, much more interacting with the sort of companies that we like to hold, and that's obviously why we've seen that pick up in bid activity within the portfolio. So they are taking out low asset intensity, high free cash flow yield, high margin service companies, technology companies, data companies, and that gives, as an investor, gives you a sort of short-term sugar boost to your returns. Our average takeout premium is approaching 50%, but the UK stock market is a poorer place for those companies that have left, particularly in an environment where we're seeing much slower IPO activity over the last year. Following a bounce post-pandemic, it's tailed off quite appreciably. So we're not replacing, the pipeline is not replacing some very high quality businesses, and that is an issue for the
UK I was going to just, if I can add to that, you do see potential, particularly if Jeremy Hunt does start changing CGT rates, that you may see some entrepreneurs that have been holding on to very small companies be willing to sell to some of the kind of stocks that we look at that buy and build. For example, something like Traxys may see more software software companies that supply to the industry they work in, which is rail operating software. So you may see some replacement at the bottom end, but it will, of course, be much smaller companies that might be, and smaller privately owned companies that may end up being bought by some of the kind of roll-up stories that we've invested in.
And just one other thing to add on that question is we don't buy companies just because we think they're going to be taken over. We're looking for good long-term investments. We do have some concerns that there's so much money waiting in private equity hands to sort of pounce on the market when it wants to and when it can get the leverage to do it. That we have many concerns about that. The public markets are really important for UK savers and for savers in all countries. They play a key role in financing businesses. Private equity flourishes really on the back of what are still pretty generous tax breaks. So when companies get acquired, they almost always stop paying tax to the host country. There are a lot of negatives that just don't get talked about enough. And we're big believers in the public markets, and at the beginning of a cycle we're going to be pretty reluctant to sell stocks to buyers. So we're mentioning this as a theme because it's going to happen, but it's not something we're kind of cheering about.
Thanks, Paul. We have a question on stocks that we've been selling recently. We've talked about the buys, have we been selling any?
I can answer that because I've been just looking at that. I mean, we haven't made many outright sales at all. It's mainly just been about reweighting. So we tended to take some profit in things that have done very well. We've taken a little bit of money out of the energy sector because it's performed so well this year, and we've been reallocating a bit. Immediately after the quasi-Kwarteng growth statement, we took some money out of the more cyclical end of the market, just as a kind of, because it seemed such a crazy world we were going into. Actually, since then, when there's more common sense came in, we managed to buy those back and reinvest some money. So we tried to take a little bit of advantage of that market turbulence, but it was more just that it was just seemed so extraordinary what happened in September that we felt we had to reduce our risk, and then since then we've been inclined to increase it. But this is really around the edges, and we've not been making any big fundamental changes.
Great stuff. Thank you very much, Paul. Another question here on our global exposure. So given the relatively high global exposure of companies within the portfolio, what exposure do you have to the US market in particular?
I'll maybe cover that one, Colin. Just to be clear on what we were trying to suggest in the slides, we're really just putting forward the proposition that the sterling weakness may now be over. We're certainly not suggesting that sterling's about to recover sharply. And I think Paul made reference to it in terms of the context of the portfolio. We have just over 50% of our sales revenue across the portfolio in non-UK. So that compares to the Numis index, which is probably kind of 40, 45. So I think we will always have a very healthy exposure to global businesses within the fund. I don't see that changing at all. So really, the comment on the currency was just a nuance in terms of sterling stabilising. I think Paul alluded to it a moment ago. We have started to buy back some of the sectors which were most impacted by the recent budget in particular. So for example, we've been looking at the real estate sector in the UK, which we think is very attractive. So we're selectively adding to some UK domestic assets, but overall we don't see a significant shift in the makeup of the portfolio as a result.
Thank you, Scott. I have a question here about inflation. I wonder if I can put to Paul. Do you think inflation will start to tail off next year? If so, will that lead to an adjustment in your holdings?
I think our view is that inflation is going to tail off next year, and I think one of the key determinants of that is going to be the money supply growth. And in the US in particular, money supply growth has gone negative in the last couple of months, which is actually a bit concerning. That's jamming on the brakes incredibly hard to do that. I therefore think that the Fed is not too far away from easing its policy to a degree, and or to at least decelerating the pace of interest rate rises. So yeah, I think inflation is going to come off. The big unknown factor, of course, is energy, and we debated a bit whether to talk about energy today. We think we're probably going to do something on energy next year. The gas situation in Europe remains critical, and remains. There's some big factors which could go one way or the other. The temperature of this winter is absolutely key. We really, if we've ever needed a warm winter, we need it this winter. We need the wind to blow and this kind of thing. So next year it's quite fragile. It does ease up in the longer term, but I think we are into one more year of pretty volatile energy prices, and potentially, the governments in Europe are going to be looking at really significant energy market reform. It's clear that actually the design of our energy market is really not fit for this scenario that we have at the moment. It's unbelievably complicated. If anybody tells you they understand the energy market, don't believe them. It's an unbelievably complex market. So reforming it is really difficult and will take a long time, but looks like it's necessary. yeah, so but with energy aside, we think that actually inflation should now start to come back, and I don't think these big inflation overshoots are going to be repeated that we saw in 2022.
Excellent, thank you, Paul. And a further question on the cash in the fund: is it lower than normal now, and do you anticipate this reducing in the near future? So the cash level in the portfolio today.
The cash level is actually at the kind of level it's been for the last few months. It's 6%ish, and actually we have one company that we still have on the books, which is being taken over. So that's kind of quasi cash of about another %. But yes, I think it's certainly possible that we'll bring that down a little bit. We use cash because we need liquidity. We need to be able to respond to opportunities. We obviously, we don't when we always want to be able to finance any redemptions from cash. We don't want to end up having to sell things at bad times because of that. And we've actually, I think, managed that really well this year. We've never been in a situation where we've been selling stocks to meet redemptions. We've always managed to keep good control of that. But yes, I could imagine our cash level might fall a bit in the next few months.
Great stuff. Thank you very much. We have another question on the Bank of England. Can you give us your comments on whether you think the Bank of England have been asleep at the wheel?
Gosh.
I'll just start to say very quickly, I personally do. Yeah, I think the central banks have made really significant mistakes in 2020. Actually, it goes back to 2020, and then they carried on making them in 21. And 2020 was kind of maybe understandable because in the pandemic, this was so new and shocking that maybe excessive responses were least understandable. But to carry on with such a high level of printing money and ultra low rates, it was always going to be massively inflationary, and they just abandoned the theory of money supply and how that was. How you expand money supply by 15%, you get very high inflation. It's just, and it's like they didn't believe it, or they thought we were in a different kind of world, or they thought inflation had died. So yes, collectively they've reinvented inflation in a way that is deeply unhelpful.
But as we said, I mean, and the invasion of Ukraine has certainly not helped, because just as perhaps supply issues were starting to ease to some extent, then that invasion did not help. But what will be interesting to see too is if China does seems to be on the path of unlocking from strict COVID policies, that might also then start providing an inflationary aspect next year, as they will start demanding more commodities, and that includes the LNG that they weren't buying this year, that we've been using to that Europe has been importing and trying to store ahead of the winter ahead.
Great stuff. Thank you, Anna. I have a final question. You talked a bit about catalysts and valuation, but what are the balance of risks versus reward for investing in small cap now? David, could I put that to you?
Yeah, as ever, any investment decision is about the balance of risk and reward. And whilst Scott has indicated that there is very significant potential reward in small cap, we clearly still have potential downside risk to come. And at any point in time, it's about, as Paul said earlier, the capital markets, UK stock market is a discounting machine. How much of the bad news is already priced in? As stock pickers, from the bottom up at the micro level, one comment we would make is that we can see some indications of that already in share price reactions to individual company announcements. Some of the most heavily sold off segments of the market, which includes retail, house builders and others, where companies now are updating and still indicating further earnings downside risk. We're not necessarily, it's not universal, but in many cases we're not seeing significant further selling pressure on those companies shares, which suggests that the market is reaching a point of selling fatigue, and that would be a necessary precursor to the market beginning to discount 2 years forward and starting to buy recovery. So can't really ever give any specific advice on timing. It's a question of, are we closer to that turning point than we have been? And I think we've tried to indicate today in the presentation that we think there are a number of catalysts that would suggest we are.
Thank you very much, David. So that's all the questions. So thank you very much for those. With that, we'll bring the presentation to an end. We're keen to keep you up to date with our thinking, and Bright Talk's a good platform for that, allowing you to put these questions, and I suppose listening to the questions put by your peers. But in addition to that, we have monthly updates, manager interviews, and thought pieces that can be found on our website. So I would guide you to have a look at those too. If you've any further questions, please get in touch with one of the sales team, Rachel, myself, or John. And until the next time, thank you very much once again. And we'll speak to you with no doubt at the VCT presentation next week. Bye just now.